Hi there, it's Duane over at San Jose Options, and I'm putting together a series of real quick and basic videos here because there's several folks that are brand new to options, and some extra background and basic information is certainly required. So I'll be doing a series on basic puts, calls, introduction to some spreads, and then finally introduction to an iron condor. So let's go ahead and get started, and we'll begin with the call. Now first off, an option, maybe that's a better place to start. Option is basically just a contract. It's a contract between a buyer and a seller set around a time and a price. Each option contract basically controls 100 shares of stock. So let's take a look at this one that I have on my screen right now. In this case, we're trading an index, the Russell index, and in this case we're buying a call. We have the strike price of 10.20 and the current price of the Russell is about 9.60. The green line here is the expiration curve. That basically shows what the value of this option is going to be at expiration, because remember I said there's a price and time limit for each and every one of these contracts. So clearly in this particular case, since the price of the underlying security, the Russell index, is right here at 960 right now, the buyer of this position would think that the trade is going to move in the upward direction, get into the money before the July time period expiration. Now in order to buy this contract, you have to go over to the option chain to see how much it's going to cost. If you look here at the strike prices, which is really nothing but a list of different prices that you can position your trades around. And if we look right here at the 10.20, because that's the strike that's being used, we can see that the pricing for this would be around $4.60. I'm just looking at the bid and the ask price, because like any other market, there's buyers and sellers, each trying to maximize their position by getting the best possible price. So in this case, we'll just say it's somewhere between the two and call that $4.60. So you can see if nothing happens as far as the price of the Russell, say it moves back and forth like this, the amount of money at risk for this purchased option would be $460. So we need to make sure in this case the price is moving up, and moving up quick enough so it can get into the money above our 10.20 strike before the July expiration. Now as the owner of this particular contract, you have the right to buy these shares at 10.20, which is our strike price, no matter how high the price goes. So you can see that it's very advantageous if in fact you're correct in the directional and the momentum of your particular position to be able to buy a much higher valued underlying security at the strike price identified. Of course, what you're risking is if in fact the price does not move quick enough to get to where it needs to be, the premium that you spent to buy that contract is potentially at risk. So let's go ahead and look at one other thing real quick. Let's look at, instead of buying, you're the seller of that. Well, as expected, instead of spending money to buy the position, you're actually gaining the premium to sell it. But you have to look out here, because just like we saw with the purchase of the call, if in fact the price runs up to the point that we're in the money, now you're going to be obligated to provide those shares at the strike price, 10.20. So again, if the price in this case has run way up to 10.50, you more or less are going to have to buy the shares at 10.50 and provide them to the owner of that call at 10.20. So in other words, a $3,000 loss. So there you have it, a real basic intro to the options in general, a call option, be it buying it or selling it, an introduction to the price movement and time period relationship to make sure that your position moves to where it needs to be within the allotted amount of time. So I'll be doing a couple other quick ones on basic puts and the spreads. So take a look, see if you can find those, and I hope you enjoy them.